You're standing in the checkout line at a grocery store on a quiet Saturday morning. The person in front of you is buying cereal, milk, eggs, and a few vegetables. Nothing unusual, until they pull out two different cards. The first card pays for the groceries. The second card collects reward points that they'll later transfer into airline miles. The cashier smiles. The receipt prints. The entire interaction lasts less than 30 seconds. But what just happened is something most people never think about. One person simply bought groceries. Another quietly used the same purchase to move one step closer to a free vacation. Neither earned more money. Neither spent more money. One simply understood a financial system the other never learned. And that's exactly how wealth usually works. Not through one life-changing decision, but through hundreds of invisible ones. Think back to when you were growing up. School probably taught you how to calculate percentages, how to write essays, how to memorize historical events. But nobody explained why banks love customers who only make minimum credit card payments. Nobody showed you how inflation quietly steals purchasing power every single year. Nobody explained why investing $300 every month at 22 can be worth dramatically more than investing $600 every month starting at 35. Nobody even mentioned that taxes are often one of the biggest lifetime expenses most people will ever pay. Instead, most of us graduated believing money worked in a very simple way. Go to school, get a good job, work hard, save what's left, retire someday. It sounds reasonable until real life begins. Your first paycheck feels exciting. Then payroll taxes appear, health insurance deductions, rent, utilities, groceries, gas, phone bills, subscriptions you forgot you even signed up for. Somewhere between your first apartment and your first promotion, money starts disappearing faster than it arrives. You don't feel irresponsible. You just feel confused. Because every time your income increases, your expenses somehow find a way to keep up. Economists call it lifestyle inflation. Most people simply call it adulthood. Now imagine another family, not billionaires, not celebrities, just parents who quietly treat money differently. Friday evening, everyone's eating dinner. Someone mentions that the stock market dropped today. Nobody panics. Someone else says dividend payments arrived this morning. A teenager asks what a dividend is. Instead of changing the subject, the parents spend 2 minutes explaining that some companies share part of their profits with shareholders. That's it. Conversation over. Nobody gives a lecture. Nobody opens a textbook. Nobody says, "You need to become rich." But that teenager just learned something millions of adults still don't understand. Money can produce more money. Next week, the same family is driving past a shopping mall. Someone points at a brand new luxury SUV. It looks nice. The parent nods. It does. Then quietly asks, "Would you rather own the car or own part of the company that built it?" The question hangs in the air. Nobody answers immediately. Years later. That child probably won't remember the exact conversation, but they'll remember how their family thought. That's how financial habits are usually passed down. Not through instructions, through repetition. Researchers call this financial socialization. The concept is surprisingly simple. Children don't usually copy financial advice. They copy financial behavior. If they constantly hear, "We can't afford that," without ever hearing why, money becomes associated with fear. If every paycheck disappears before the next one arrives, living paycheck to paycheck starts feeling normal. If every raise immediately becomes a nicer apartment, newer car, or a more expensive lifestyle. Then higher income becomes permission for higher spending. But if children regularly watch adults investing before spending, discussing taxes before making financial decisions, comparing assets instead of brands, thinking about long-term ownership instead of short-term status, those behaviors eventually become automatic, not because anyone forced them, because they were repeated thousands of times. That's one of the biggest differences between financial education and financial conditioning. Education tells you what to do. Conditioning determines what feels normal. Think about your own life for a moment. How many financial decisions were actually your own? And how many simply felt normal because that's what everyone around you always did? Financing phones every 2 years, replacing perfectly working cars, treating tax refunds like bonus money, keeping savings in accounts earning almost nothing while inflation quietly reduces their value every single year. None of those habits usually begin with bad intentions. They begin with familiarity. Now picture another ordinary Tuesday. Your paycheck lands. Before you even wake up, part of it automatically moves into a retirement account. Another portion goes into a high-yield savings account. Another buys shares of a broad market index fund. The checking account still has money left for bills. Nothing feels exciting. No celebration. No social media post. Just another normal payday. And that's exactly the point. Wealthy families often remove emotion from repetitive financial decisions. Investing isn't something they remember to do. It's something that already happened before breakfast. Because they understand something that's almost invisible. Every financial decision competes against time. Spend today, or allow that same dollar to begin working for tomorrow. Neither choice feels dramatic, but repeated over 20 or 30 years, the gap becomes enormous. That's why two people earning exactly the same salary can end up living completely different financial lives. One spends first, then saves whatever survives. The other invests first, then builds life around what's left. From the outside, their neighborhoods may look identical. Their cars may cost about the same. Their children may attend the same schools. But beneath the surface, one family is quietly building ownership. The other is quietly financing consumption. And almost nobody notices the difference until 20 years have already passed. A few years pass. You get promoted. Your paycheck is larger than it has ever been. For the first time, you feel like you're finally catching up. Then something strange happens. The apartment you've always wanted suddenly feels affordable. The monthly payment on a newer SUV doesn't seem impossible anymore. The premium credit card promises airport lounges, travel points, and exclusive rewards. Friends around you start upgrading everything. Better neighborhoods, designer furniture, luxury vacations. It doesn't feel like showing off. It feels like keeping up. And that's exactly why lifestyle inflation is so dangerous. It rarely announces itself. It quietly grows beside your income until one day you realize you're earning twice as much as you did 5 years ago. Yet somehow, your bank account barely looks different. Now imagine another version of that same year. The promotion still happens. The paycheck is still bigger. But before you even decide how to spend it, 40% of every raise is automatically redirected. Some goes into your 401k, some into a Roth IRA if your income allows it, some into a brokerage account invested in a low-cost S&P 500 index fund. A small amount strengthens your emergency fund. Only what's left becomes available for spending. Nothing feels exciting. Nobody congratulates you for increasing an automatic investment by $250 a month. But future wealth is usually built inside decisions that nobody applauds. Think about the first time someone explained compound interest. For most people, it happened after they already had debt, not before. That's backwards, because compound interest works in both directions. When you owe money, it quietly works against you. When you own productive assets, it quietly works for you. Imagine putting $400 into a diversified index fund every month. 1 month doesn't change your life. 1 year doesn't look dramatic either. But after decades, a significant part of the portfolio's growth no longer comes from your deposits. It comes from previous growth, creating even more growth. That's the moment money begins doing something your paycheck never could. Working 24 hours a day, without asking for overtime, without requesting a vacation, without getting tired. The earlier that process begins, the more powerful it becomes. Time is often the greatest financial asset anyone will ever own, yet it's the one resource nobody can buy back. That's why financially educated families rarely ask, "How much did you make this year?" Instead, they quietly ask, "How much of your income bought another future paycheck?" Those two questions sound similar. They're completely different. One measures effort, the other measures ownership. Ownership quietly changes everything. Imagine two neighbors living across the street from each other. Both earn around $110,000 a year. Both have children. Both shop at the same grocery store. From the outside, their lives look almost identical. Inside, their money follows completely different instructions. The first family sees every paycheck as spending power. The second sees every paycheck as capital. The first upgrades phones every 2 years because the monthly payment feels manageable. The second keeps working phones a little longer and quietly buys additional shares of businesses they already own through an index fund. Neither decision feels life-changing. But repeat that pattern for 20 years, and the difference becomes enormous. This is exactly why wealthy families often teach ownership before consumption. Children hear conversations that sound ordinary. "We received another dividend." Our investments increased their quarterly payout. The rental property covered its own expenses this month. The company increased its annual dividend again. None of those conversations are complicated. They're simply normal inside that household. Eventually, the child grows up believing assets are supposed to produce income, not because school taught them, because dinner conversations did. The same thing happens with taxes. Most people think about taxes once every spring. Financially educated families think about taxes before making major financial decisions. Should retirement savings go into a traditional 401k or a Roth account? Would long-term capital gains receive different tax treatment than short-term trading? Would contributing to a health savings account reduce taxable income while helping pay future medical expenses? These aren't secret loopholes. They're publicly available rules. The difference is that one family learns them before making decisions. Another learns them years afterward. Knowledge changes timing. Timing changes outcomes. Perhaps that's why financial education feels so different from almost every other subject. Math rewards correct answers. Money often rewards correct habits. And habits don't usually change because someone reads one great book. They change because one ordinary financial decision gets repeated again and again until it becomes automatic. That's the moment money stops feeling complicated. Not because you know everything, Because your system keeps making good decisions even on the days you don't think about money at all. The biggest financial lesson most people learn usually arrives too late. Not because the information was hidden, because nobody thought it was important enough to teach before life started charging tuition. Imagine it's 10 years from today. You wake up on an ordinary Monday morning. Nothing extraordinary has happened. No lottery ticket, no inheritance, no viral business, no miracle investment. Just 10 years of repeating the same financial system. Your emergency fund quietly covers 6 months of expenses. Your retirement accounts have been growing for years without needing constant attention. Your investments now generate dividends that buy even more investments automatically. The market has gone up. The market has gone down. Recessions came and went. News headlines predicted disaster more times than you can count. Yet your system never stopped. Because good financial systems aren't built for perfect years. They're built to survive imperfect ones. That's something wealthy families understand remarkably well. They don't try to predict tomorrow. They prepare for it. Think about the biggest financial decisions most people make. Buying a house, changing careers, starting a business, having children, retirement. Each one is emotional. Each one feels urgent. But beneath every emotional decision, there's usually a mathematical one. Can your cash flow support it? Will this purchase appreciate or depreciate? Does it create another monthly obligation or another income-producing asset? How much tax will this decision create? How much freedom will it remove or add? Most people ask those questions afterward. Financially educated families usually ask them first. That's why their conversations sound different, not smarter, just earlier. Instead of asking, "Can we afford the monthly payment?" they ask, "What is this money no longer able to do if we spend it here?" That's opportunity cost. And once you begin thinking that way, almost every purchase starts looking different. That luxury watch isn't only an $8,000 watch. It might also represent years of potential compound growth. The newest luxury SUV isn't only a monthly lease payment. It's also money that could have quietly purchased productive assets every single month instead. Neither decision is automatically wrong. The difference is awareness. Financial freedom is rarely about saying no forever. It's about knowing exactly what you're saying no to when you say yes to something else. Perhaps that's why schools struggle to teach money. Financial literacy isn't memorizing definitions. It's recognizing trade-offs. Every dollar has more than one possible future. Spend it. Save it. Invest it. Protect it. Donate it. Every choice closes another door. The earlier someone understands that, the less likely they are to drift through decades making expensive decisions on autopilot. That's exactly what wealthy parents often try to teach, not because they expect perfection, because they understand repetition. A child who watches investments happen every month eventually believes investing is normal. A child who hears calm conversations about taxes eventually sees taxes as something to plan for, not panic over. A child who grows up watching adults compare ownership instead of status quietly develops a completely different definition of success. The lesson isn't become rich. It's much simpler. Build systems that continue making good financial decisions even when you're busy, distracted, or tired. Automation quietly beats motivation every single year. Now think back to the beginning. That old report card, the straight A's, the perfect attendance certificate. They were never worthless. They simply weren't enough. Because life eventually asks questions that never appeared on any exam. How much should you save? Why does inflation matter? How does compound growth actually work? When should debt be avoided? And when can it become a useful financial tool? How do taxes quietly shape long-term wealth? No report card ever prepared you for those questions. Your habits did. Or they didn't. And that's why two people with similar education, similar careers, and similar incomes can arrive at retirement living completely different lives. One spent decades increasing lifestyle. The other spent decades increasing ownership. One relied on earning more. The other built systems that made every dollar work harder. Neither journey happened overnight. Both were simply the result of thousands of ordinary financial decisions repeated over many years. Maybe that's the real money system wealthy families pass to the next generation. Not secret investments, not hidden bank accounts, not impossible shortcuts. Just a different way of thinking before money is ever spent. Because wealth rarely begins inside an investment account. It begins inside everyday decisions nobody else notices. The paycheck that gets divided before it's spent. The raise that increases investments before lifestyle. The purchase that gets delayed because tomorrow matters more than today. Those moments never feel dramatic. Nobody applauds them. Nobody posts them online. Yet those quiet decisions often become the difference between spending an entire lifetime working for money, or slowly reaching the point where money begins working for you. The next paycheck you receive will eventually disappear somewhere. Rent, bills, food, taxes, entertainment, investments. The only question is, will every dollar leave with a purpose, or will it simply disappear because nobody ever told it where to go?